All right, hello everybody. Hope all of you are doing well. Just wanted to talk a little bit about gaps. And we're going to look at Amazon. And I thought this was kind of apropos, if that's even a word, or appropriate. I see this Amazon truck in my driveway like every day. And the guy who drives it even told me, it's like, dude, your wife is our best customer. So this is why once a year we get like a huge dumpster because we have to throw out a bunch of stuff that we didn't need. But that's a different conversation. We're not going to do marriage counseling. We are going to talk about ways to make money in the market. And I want to go over what gaps are. There's an old saying, gaps tend to refill, and it's true. And if you understand the principles that I teach about how the market works, about supply and demand, and about investor psychology, it will be easy for you to get this. So let me just go right into it. I want you to look at something here. Notice how this level that was resistance turned into support. Notice how this level that was support turned into resistance. How does this happen? Well, it's investor psychology. Resistance, well, let me explain what resistance is. When a market is moving higher, there's not enough supply or sell orders to fill off the demand or buy orders. So the buyers have to be willing to pay a premium, and this forces the market into an uptrend. When we get up to a resistance level, the tide turns. Resistance is a large group of investors who are looking to sell at or around the same price. In this case, it's 125. When the market's moving lower, there's not enough demand or buy orders to absorb all of the supply, and sellers need to offer their shares out at a discount. This forces a downtrend. When we get to a support level, we have enough demand. This is in trader talk. This is where the buyers come alive. We have enough demand to take in all of the supply or sellers. In other words, the sellers don't need to push the price any lower. There's enough buyers there that they can sell whatever they want. Now, why would resistance become support? This is because we have seller's remorse. There are people who sell here who, when the price goes higher, regret doing so, and they tell themselves, I'm going to buy my shares back, but I'm only going to do so if I can get them at the same price I sold them at. So if you have enough remorseful sellers placing buy orders at the level that was resistance, what was resistance can convert into support. It's psychology. Charts are all about psychology. They're not about astrology or reading the tea leaves. They're graphical illustrations of investment psychology. Here we have support, which turned into resistance. How does this happen? This is because of buyer's remorse. People buy, price goes lower. A lot of them who bought, who still have their shares, tell themselves, I made a mistake. I want to sell, but I'm only going to do so if I can get out at break even. So if there are enough remorseful buyers placing a sell order at a level that was support, the level that was support can turn into resistance. So, important concept. Former resistance levels can become support due to seller's remorse. Former support levels that can become resistance due to buyer's remorse. Let me say that again to make sure I said it right. Levels that were resistance can become support because of seller's remorse. Levels that were support can become resistance because of buyer's remorse. And that brings us to the gap. Now, notice how there is a gap here, and there's a gap here, okay, and a gap here. A gap is a term for when a stock or a market is trading. It doesn't matter the market, crypto, stocks, bonds. I'm just going to stick with stocks just to make it easy. But when a stock gaps through levels, it means it doesn't actually trade there. On this particular day, Amazon closed here, and the next day it opened up here. So in between here, which is 103 to 110, there was no trading. All right. One of the reasons why we get resistance is because we have remorseful buyers trying to sell to get out at break even. If the stock never traded there, there can't be people who bought who are trying to get out. So if we gap one way and the market eventually goes down in this case and comes back and we get up to these same price levels, it can gap right back through it because there aren't any remorseful buyers trying to sell. So there's going to be this lack of sell orders. Buyers who want to buy, they can buy the stock, but they're just going to have to pay a big premium. This forces us higher. And here we can see it even, we even gapped up. The buyers couldn't find any sellers until they got back up to 110. The very next day, we got gapped back down. Why do we have support? A lot of times it's because we have remorseful sellers trying to buy their shares back. If we gap up through levels, it didn't trade there. If it didn't trade there, then you can't have someone who sold it trying to buy their shares back. It didn't trade there. No one sold it. So gaps tend to refill, and that's why. If you can understand the concept of how seller's remorse turns resistance into support, like here, and you can understand how buyer's remorse turns support into resistance, it's easy to understand this concept of gaps, okay? Now, something doesn't have to be an actual gap. Well, here we see some gaps, but this is a principle of markets. If we make a fast move higher through certain price levels and then eventually reverse and we come back down, we move quickly back through them. If a market moves quickly through price levels, or gaps through them, but if it moves quickly through price levels and then eventually reverses and comes back the other way into those price levels, there's a tendency to move really quickly right back through them. That's because we have this lack of vested interest. If there weren't people buying and selling, well, there's not going to be people trying to buy their shares back or sell their shares. So here we have another example. Fast move higher, fast move lower. When we just rip higher really fast through these levels, there's just not a lot of people who sold. There's not a particular price level where there was like a large concentration of sellers who are trying to buy their shares back. So fast move up, fast move down. Here we have the opposite. Fast move down, fast move up. When we move this fast through price levels, there's not enough time for people who bought who want to get out at break even. So when we turn around and we come back, you don't have this group of remorseful buyers trying to sell. So there's a lack of supply. Buyers need to be willing to pay higher prices. So this is why gaps tend to refill. It's an old Wall Street saying, and it's true. I'm going to just show you a closer up time period of this. So this is what we were just looking at, but it's a more condensed time period, just so you can see better. Gap down, gap up, gap up, gap down. Fast move lower, fast move higher. These are things that traders in the institutional world look at because you want to know where to place your buy order or your sell order. You need to let the market tell you what to do. You might be wrong. The gurus might be wrong. I might be wrong. Politicians could be wrong. The market is never wrong. So an example like here, well, we gap down really fast. Say you bought the stock here and you were looking for a place to sell it. Oh, gee, 103. There was resistance there, and there's a good chance we we move really quickly back to those levels. So that's the story with gaps. But if you're listening to me right now, I want you to understand something. If you do technical analysis correctly, what you're looking at is a graphical illustration of supply and demand and market psychology. Markets don't move because of what they're talking about on CNBC or Fox Business News or Bloomberg. Most of the time, markets are moving because investor perceptions. For example, right here, investors thought Amazon was 103. The very next day, they thought Amazon was worth like 115. What changed in these 2 days? Well, the very next day, Amazon was back down to 103. What changed in these 3 days that made this company that's so huge lose and gain so much market valuation? The answer is nothing other than investor perceptions. I'm going to say it again, the vast majority of moves in the stock market are because of investment psychology or investor psychology. It's not because of some underlying fundamental reason that the media is trying to attribute it to. Most people in the media are journalists. They're not former traders. They don't understand how this stuff works. All right, everybody, I hope that helps you out. If you have any questions, please feel free to contact me, Mark at stockmarketjobber.com, and I will see you soon.